everybody. This is Rachel from the CME, and today we are really happy to have Erik Norland, our senior economist and executive director, here to share with you the market outlook for the rest of 2019 and the impact of the global growth, especially on Southeast Asia and Malaysia. So without further ado, I'll pass the time to Erik.
Yes, thank you so much for inviting me and for giving me the opportunity to present to you this evening on a whole variety of topics. So talking about the impact of slowing global growth. We're seeing a slowdown in India, China, Japan, Europe, maybe soon the United States. All of this is going to have an impact on a huge range of different assets, including those that trade here in Southeast Asia, as well as international commodity markets, including vegetable oils like palm oil and soybean oil, precious metals like gold and silver, as well as the global equity markets. So without further ado, let's get into the presentation. Before we get into the meat of the presentation, I am required to show you both the short version as well as the longer and much more detailed version of our disclaimers, which basically say that because CME Group is an exchange operator and not an investment bank or a broker-dealer, we cannot provide you any investment advice. So the focus of the presentation will really be on the economics of these markets and what the upside risks and downside risks are for different markets. But I figured we could start with the agricultural markets. One of the most remarkable things about the agricultural markets is the extent to which major crop prices around the world follow certain emerging market currencies. So if you are trading wheat futures, they move in lockstep with the Russian ruble. If you are trading corn futures, they move in lockstep more or less, sometimes varying a little bit with the Brazilian real. Corn is a kind of strange and peculiar case because for 5 summers in a row, we have seen rallies in prices where people were worried about the harvest in the United States, and it turned out the harvest in the United States wasn't as bad as people thought, and the prices came right back down. For the most part, it's actually what's happening in South America, in Brazil and Argentina, that seems to be the more long-term driver of the price of corn. And next, you have soybeans. Soybeans move in lockstep with the Brazilian real. This is less true of soybean meal, but it's very true of soybeans, and it's especially true of soybean oil. Soybean oil seems to move very, very closely with the Brazilian real. So the reason why these emerging market currencies are having such a strong influence on the price of these various commodities becomes obvious when you look at who the exporters of these commodities are and who they've become. So if you were looking at this 20 years ago, the main exporter of wheat was the United States. It exported about 4% of global total production in wheat every year. At that point in time, what happened in places like Russia and the Ukraine didn't matter so much. Really up until even as late as 2004, Russia and the Ukraine were net importers of wheat more than they were net exporters. But that started to change around 2005, and now it's changed very, very dramatically. US exports of wheat are still positive, but they're only 3% of global total production, whereas exports from the Black Sea are now 7%, almost 8% of total global production. So what happens in the wheat market is totally dominated by what happens in Ukraine and in neighboring Russia. So little wonder that the price of wheat follows what happens in Russia. Likewise, if you are a consumer of corn, it used to be the US was the dominant exporter of corn, exporting maybe 7 to 8% of global total, while what happened in the Black Sea region and in Brazil and Argentina didn't really matter so much. Now Brazil and Argentina have caught up to the United States in terms of corn exports. And Black Sea exports are now 3% of global total. So they're a bit more than half of what's exported from the US and from South America, getting close towards 60% of what's exported in from North America and South America. So little wonder, of course, that corn beginning to follow the Brazilian real pretty closely, and increasingly also the Russian ruble. Lastly, when it comes to soybeans, 20 years ago, the US exported 15% of global soybean total. That's still true today, still around 15%. But South America has gone from exporting about 6% of soybeans in terms of global production to more than a fifth of it, up to around 22, 23%. So the US has just been outdistanced in terms of soybean production. So what happens to soybeans and to soy oil in particular is very, very closely related to the price of the Brazilian real versus the US dollar. The reason for this is simple. Roughly half of the farmers' costs are denominated in local currency terms. That, of course, includes the cost of labor, which is maybe the most important component of a farm's cost, but also other locally determined costs like the cost of land, property taxes, local infrastructure like warehouses, etc. The other half of the costs are, of course, global. That includes the cost of farm equipment, which doesn't vary too much from one country to the other, although maybe a little bit. And then also the cost of energy, which is more or less the same throughout the world. So what's going to happen to the Russian ruble and the Brazilian real, of course, has a big role to play in what happens to these various commodities. So let's talk about that for a moment. The Russian ruble and the Brazilian real have both been fairly weak currencies over the last few years. Both of them has fallen versus the US dollar. This is bearish for the price of agricultural goods. And indeed, agricultural goods prices for the most part have been pretty soft over the last few years. So part of this is that both Brazil and Russia are very, very dependent on exporting commodities. And they export commodities mainly to markets that are either China itself or influenced by growth in China. So the trade war has not been very good news for the agricultural sector. Of course, it's had a direct impact on the US in the sense that China has vastly reduced the number of purchases it makes from the United States. And generally speaking, as the US has imposed higher and higher tariffs on China, the currency has fallen lower and lower. What's interesting, though, is the Chinese currency doesn't move that much on a day-to-day basis because China very carefully controls the evolution of its currency. But Brazil, Russia, and India do not do that, so their currencies float more freely, and they often fall in anticipation of later declines in the Chinese currency. But nevertheless, China is extremely influential when it comes to these various markets. So let's talk about how China influences the markets and how the trade war is impacting them in a moment. But just a couple more words on Brazil and Russia. So as you can see, the Brazilian real is the underperformer. It's the least strong of the four major BRIC currencies. And so part of the reason for that is Brazil is in really, really tough fiscal shape. Brazil runs an enormous budget deficit. Their government budget deficit is 7% of GDP, whereas Russia is running a surplus of about 1 or 2% of gross domestic product. So Brazil is just in bad financial shape. Bolsonaro, their new president who was elected about 1 year ago, a little less than a year ago, has already made big reforms to the pension system, and he's also reducing trade tariffs to make the Brazilian economy more competitive and to shrink those deficits. The problem is it hasn't yet begun to show strong results. Maybe it will in the future, but for the moment, the Brazilian real is a weak currency, and that's very bearish for the price of soy oil and soybeans in particular, but also for the price of corn. So when it comes to China, there's always a question, before we really get into China and how it impacts growth, there's always a question of how do you measure China's economic growth? The most obvious answer is just to look at the official gross domestic product, or GDP. The problem with this, though, is that China has extremely flat GDP. The GDP shows almost no variation. It's always growing at about the same pace of 6.2 to 7.2%, and almost never surprises a consensus estimate. So I think you really have to look for alternative measures of Chinese economic growth to determine what exactly is happening in China. And so one of the alternative measures is the Li Ka-chun index. And this alternative measure of China's GDP focuses on just three variables: the volume of rail freight, the quantity of bank loans, and the amount of electricity being consumed. And it shows much, much wider variation of economic growth in the official GDP. And this really makes sense when you look at commodity prices. So showed a much deeper slowdown during the global financial crisis, where China wasn't growing even at 6%, it was really growing at 2.5%. That makes sense. China is the biggest consumer of commodities, and commodity prices crashed during the global financial crisis. Then China stimulated its economy. Growth rates went up to officially 12%, but according to its alternative measure, maybe more than 20%. And commodity prices, of course, soared in 2010 and 2011. But then Chinese growth slid back down to maybe as little as 1.5%. By the time we got into 2015 and 2016, commodity prices collapsed again. Then commodities rebounded again as China rallied back and came back to 10% plus growth rates for a while in late 2016 and early 2017. And now Chinese growth is easing coincidentally back towards the official rate of GDP growth around 6%, and many commodity prices are moving lower. We see a lot of downward pressure on oil, which we'll talk more about in a minute. Some very strange events in the oil market recently that we have to talk about, but also lower prices for copper, for aluminum, for other industrial metals, and a lot of downward pressure, of course, on those emerging market currencies. So for example, if you look at soy oil versus the this alternative measure of GDP, Li Ka-chun index, you see that the price of soy oil often moves in the same direction, this alternative measure of GDP, but it moves about 1 year later after China's growth rate has changed, which is really strange. Why would that be the case? So we'll see that in a second. So if you look at the correlation, essentially, let me go back to this previous chart here. Look at the correlation between the growth rate in China by this alternative measure in the dotted blue line and the black line, the price of soybean oil, over variable lags. You see there's actually a really strong correlation 4, 5, 6, 7, 8 quarters in advance. So when China starts growing more quickly, initially it has no impact on agricultural goods prices. But then after about a year or a year and a half, it begins to have a huge impact. So why is that? We'll see in a second. So the hypothesis here, this essentially looks at this chart for all of these different commodities at the fourth quarter. So what impact does China have on these different instruments 1 year later? So you can see China's growth, when it accelerates, has a very positive impact on things like the Brazilian real, the Russian ruble, South African rand, Canadian dollar, and Australian dollar. All of these currencies, of course, belong to countries that are big exporters of commodities. So Brazil, as we see, is the chief exporter now of corn and soybeans. It's also an enormous exporter of iron ore and a sort of smaller exporter of copper and aluminum and other goods. Russia, a huge exporter, as we saw, of wheat and also of corn, but also a gigantic exporter of oil, second biggest exporter of oil in the world behind Saudi Arabia. South Africa, big exporter of metals. Canada, a big exporter of agricultural goods. A lot of wheat, some corn, some soybeans get exported from Canada. Canada also a huge exporter of oil and of industrial metals, in precious metals a bit as well. And so Australia, also an exporter of wheat, as well as a huge exporter of commodities like coal, iron ore, and gold. So the hypothesis here is that when China's economic growth accelerates, what that does is it causes the price of energy and metals to rise. That in turn causes the currencies of places like Russia, Brazil, Australia, and Canada to rise as well. And if their currencies rise, that increases the cost of production for their farmers. when seen from a US dollar perspective. And as that production cost rises, it puts a higher floor in the price of agricultural goods. Now, by contrast, in the last few years, the opposite has been happening. China's economy has been slowing down. That's putting downward pressure on the price of energy and industrial metals. That's weakening the Russian ruble, the Brazilian real, the Canadian and Australian dollars, and many, many other currencies. That in turn is lowering the cost of production for many agricultural goods, which is why we've seen such weak prices in corn, wheat, soy, and other agricultural commodities. So this brings us, of course, to the question of China's growth. What is the outlook for China? And of course, the key question there is how is it impacted by the trade war? So the trade war has generated, of course, enormous media attention, dominating headlines around the world. But when you actually look at the numbers, it started out pretty small. Donald Trump imposed a 10% tariff on $200 billion worth of Chinese goods, essentially a $20 billion tax that Donald Trump seems to think is a tax on China. It is not a tax on China. Of course, it is a tax on American consumers who buy goods from China. But implicitly, China does pay a portion of that tax. When Chinese companies sell goods to the United States, in light of those tariffs, many of them have to accept smaller margins, so they're maybe doing a bit of discounting. And they also have a lower volume of export growth to the United States. So we think it costs China about $10 billion per year having these tariffs on. $10 billion divided by China's $15 trillion GDP, we think slowed China's growth by about 1/10 of 1%. The problem, of course, now is these tariffs have now quadrupled. The 10% tariff on $200 billion worth of goods has now become a 25% tariff. There is also a 10% tariff that is now partially implemented on an additional $300 billion worth of goods, and that may be fully implemented by December 15th. So this $20 billion tax becomes an $80 billion tax, and this is what we think the impact is. So we think initially on US consumer prices, for example, the 10% tariff caused them to go maybe 0.05% higher. Now they will go 0.2% higher. Initial impact of the tariffs on US corporate profits was negative 0.6%. Cost companies about 0.5%. Now that's coming up more towards 2.5%. But most important for commodity markets, China. The initial round of tariffs took maybe 0.1% off of GDP. The new round of tariffs could knock maybe 0.5% off their growth. That's significant, but it's not huge and it's not devastating. We think this is not good for China, but China has means of offsetting this. One mean, which we already saw, which was to weaken the currency. Part of the irony of this, of course, is that 10% tariff was applied. China's currency fell 9%. So now Americans pay only 1% more for those goods. And then, of course, they paid 9% less for the goods that were not subject to the tariff. Since the tariff has gone up to 25%, we've seen the Chinese currency weaken about another 7 or 8%. So our guess is China's currency, assuming the trade war continues, China's currency is most likely to fall maybe another 5 to 10%, but it will do it in fits and starts, maybe over the next 6 months or so. And that may be anticipated by further weakness in other currencies like the real and the ruble, which could be bearish for agricultural goods. By contrast, if I am surprised and China and the US strike a deal, that could be very bullish for the Chinese currency and very, very bullish for the ruble and the real, which in turn could send agricultural good prices higher. But personally, I think it's unlikely Trump and Xi Jinping will come to a deal anytime particularly soon. It's going to be very hard for China to lose face and to cave into US demands. Likewise, it's going to be embarrassing for Mr. Trump if he ends a trade war without getting anything in return. So we'll see how it plays out. Certainly, both leaders are capable of surprises. Certainly, this has some influence, but it's not as big a deal as people think. So China's economy, not doing so badly, but not doing particularly well either. Export growth has gone flat, but it's not falling yet like it did back in 2008 and 9, or like it did during 2015 and 16 when their economy had a dramatic slowdown. But watch that export number. It comes out every month. You can see it on Bloomberg, on many, many other sources, straight from the government websites. And if the exports begin to show negative growth, that's pretty bad news for China. So if the trade war is not mainly responsible for China's slowdown, then what is? And the answer to that question, I think, boils down to a couple words: demographics and debt. For the last 30 years, China's working age population has grown by over 25%. During the next 12 years or so, between now and 2030, so really the next 10 years, China's working age population will fall by 5%. And that's really bad news, especially since China has so much debt. You know, we looked at that chart of China's official and unofficial GDP. We saw that back in 2008, they had a big slowdown, and then they kicked that growth rate up to over 20% by the unofficial measure and over 12% by the official measure. They did that by taking on huge, huge amounts of debt. So back in 2009 and 10, China encouraged its non-financial private sector to borrow huge amounts of money to invest in infrastructure. And they did it, and they got really strong growth. And that was hugely positive for emerging market currencies and for commodities, both of which recovered very nicely from the global financial crisis. The problem is China's debt level has since then gone higher and higher and higher. And not shown on this chart, just on Sunday, the Bank for International Settlements updated the series for China and showed that in Q1, their debt level spiraled 5% from 254 to over 259% of GDP, which is an enormous growth for one quarter. So China's been stimulating their economy by taking on more and more debt. Their debt levels now look like very slow-growing places like the USA, Eurozone, and the UK. This is really bad news for China. And I think their economy will likely downshift to a much slower rate of growth during the 2020s. And as that happens, that will be very bearish for emerging market currencies and for commodity prices, especially for industrial metals like copper and aluminum. Now, one of the great hopes, of course, is that if China ever slows down, that India will pick up the demand. And unfortunately, that is not happening. India's economy is also very unexpectedly slowed down. This, I think, is really disturbing news for the commodity markets. It may herald a weaker Indian rupee. India is not alone, of course. There are other emerging market economies that are struggling. Russia is not growing particularly fast. Brazil seems to be in a double-dip recession. Mexico is in a recession. There's a lot of weakness there in emerging markets. All of these central banks are trying to offset this by cutting interest rates. India also recently cut its corporate tax rate. Hopefully these policies will succeed. Hopefully Bolsonaro's policies succeed in Brazil and economic growth improves in the emerging markets. But for the moment, as of Q2 and Q3, that growth looks very, very weak in many of these places. So when it comes to the agricultural goods markets, people often ask, so what is the relationship between agricultural goods and energy? So we've seen that China influences energy prices. When China's growth slows, energy prices crash. When it accelerates, energy tends to rally. But what's really weird is this. Energy does not anticipate what will happen in soybeans or in palm oil. It's exactly the opposite. Soybean oil and palm oil tend to anticipate moves in energy. If you look back at 2005 and 2006, West Texas Intermediate crude was rallying. Soybean oil went nowhere. What happened? Oil crashed back to the level of soybean oil. But then in late 2006, soybean oil began rallying. Crude oil followed it. Soybean oil peaked in January 2008. Crude oil peaked 6 months later in July 2008. Then, of course, both prices crashed, but soybean oil hit bottom in December 2008. Crude oil 2 months later in February 2009. So soybean oil, of course, peaked before crude oil did in 2011 and began a long slide that anticipated the eventual crash in crude oil prices. Since then, soybean oil rallies and falls have mainly anticipated what will happen next to crude oil. Recently, soybean oil has been rallying a little bit, not a spectacular rally. And of course, we have this bid in oil. We'll talk about it in a second because of those very, very strange events in Saudi Arabia. For those of you who trade palm oil over at Bursa Malaysia, this is palm oil translated from ringgit back into US dollars, just to make a consistent basis with the price of crude oil. A very strikingly similar relationship. Almost as good as soybean oil, if not as good. So what explains this? Why would vegetable oils anticipate what will happen to crude oil? Well, as I'm sure you all know, Bursa Malaysia palm oil and CBOT soybean oil are very tradable contracts. You can get into and out of these markets with not too much of a problem. But that said, palm oil and soybean oil are very small markets compared to crude oil. The average daily dollar volume in those markets is about 1/20th or 1/25th the size of the enormous crude oil market. So you combine the small size of these veg oil markets versus the enormous size of crude oil with the fact that 65 countries around the world have some sort of biofuel mandate. And what happens is that countries like China, Brazil, Indonesia, the United States, the 27 nations of the European Union all have biofuel mandates. And so what happens in these countries is that if the oil refiners have too much oil in inventory, they tell the farmers, thanks, we don't really need any more veg oil. We're going to take it down to the legal minimum. So the veg oil markets, being small, become hypersensitive to fluctuations in crude oil demand, and they rise in advance or fall in advance of those moves. Of course, if there's a shortage of crude oil coming, you see the opposite happen. When there's a shortage of crude oil, the refiners call up the farmers and say, hey, could we have more palm oil, soybean oil, ethanol from corn, ethanol from sugar, etc., in order to mix into our refined fuel blends, plastics, whatever it is they're producing. And these little tiny markets, which are, of course are big markets, but little tiny compared to crude oil, can rally in advance of crude oil prices, which brings us to the incredibly strange events in the crude oil market. So let's review. September 8th, Saudi Arabia fires its crude oil minister, Khalid al-Fatih. Fired him on September 8th because Saudi Arabia was dissatisfied with the low price of energy and the slow progress made towards the privatization of the Saudi oil company Aramco. That's September 8th. 2 days later, John Bolton, the ultra-hawkish, warlike advisor to President Trump in Washington, D.C., either quit or was fired, depending who you ask, who knows. And apparently because he disagreed with Trump's stance not to militarily attack Iran, and also because he disagreed with President Trump's offer to meet with the president of Iran, Mr. Rouhani, to work out their differences on the Iran nuclear situation, sanctions, etc. So, okay, that happens on September 10th, 2 days after the firing of the Saudi oil minister. And then 4 days after that, on September 14th, you have this drone attack that blows up Saudi oil infrastructure and apparently takes half of Saudi Arabia's oil production off the market. So you would think this would be the biggest piece of news ever to hit the oil markets. And indeed it did influence the oil markets. I mean, if you look at the prices here in WTI and Brent, they had an enormous update. They went up 14% the next day. You go back to this chart, you look at the implied volatility on oil options. Yes, implied volatility spiked, but it kind of went back to like the middle of its range from 2007 till now. Like it wasn't really that big of a deal, right? Oil prices spiked, but they're kind of in the middle of where they've been since 2018. So think how weird this is, right? Let's think about this. So Saudi Arabia is the world's biggest oil exporter, produces 12% of total world oil. Half of it gets knocked offline. That's 6% of global total production. And the price of oil moves up only 14% and then can't sustain the rally and then starts selling off again. And so Saudi Arabia, of course, releases these photos of this oil refinery, completely on fire, oil facility completely on fire, and says, oh, actually, no, it's going to be back and operational in 2 weeks, so don't worry. Okay, this is just a really strange story. I personally don't quite know what to make of it. There are many possibilities. It could be the damage wasn't as bad as what people initially said it was. It could be that Saudi Arabia really will bring it back very quickly, so maybe they have other facilities they can use. Tons of possibilities. It could be that the Iranians launched the attack because hardliners in Iran did not want Rouhani to negotiate with Trump, or it could be they launched the attack because they did not want Saudi Arabia to benefit from the IPO of Aramco at the same time as Iran was suffering. But anyway, just a very, very strange thing, particularly strange in light of the fact that you had this huge run-up in crude oil prices, like a 30% gain back in 2011, at the very beginning of 2011 with the Arab Spring, when maybe 2 or 3% of global production was taken offline. Another explanation for why the markets didn't react so much is inventories. Inventories are just much, much higher now than they have been at most points in the past. So it could be that people thought, okay, this is a huge deal. Saudi Arabia's oil infrastructure is enormously vulnerable in a way that we never really thought about or imagined in the past. It would actually be struck by a foreign power, or maybe not by a foreign power, who knows. So anyway, but because oil inventories are extremely high, maybe that buffers the impact. Another possibility, people might not be so nervous about what happens in Saudi Arabia because they are no longer the swing supplier of oil, and the swing supplier of oil is not Saudi Arabia anymore, but the United States, which has increased its crude production from 5 to over 12 million barrels per day. So U.S. oil production, of course, comes from many regions. Some of it's offshore in the Gulf of Mexico, some of it's way up in Alaska. But the increase in productions all come from these 7 colored regions. And these are the regions in which shale fracking is taking place. And the biggest area of increase is down in West Texas, that sort of brown-colored area called Permian. The other 2 to watch are Eagle Ford, the purple place, also in Texas, and Bakken, way up north on the Canadian border up in North Dakota and a little bit into Montana. So if you look at these regions, Permian, West Texas oil, or Midland oil, has been soaring, going from less than 1 million to well over 4 million barrels per day over the course of the last decade or so. What's interesting, though, is that while Permian has been increasing very quickly and it's been more or less impervious to the crash in oil prices that took place between late 2014 and early 2016, the other production areas like Bakken and Eagle Ford, they actually saw a dip in production. They've never, ever recovered. So why did they not recover? Why did Permian production increase while Bakken and Eagle Ford decreased? And the answer comes down to transportation costs. So Bakken's way up there in North Dakota. If you want to get oil out of North Dakota, it costs $7 to $12 per barrel to send it either to the trading hub in Cushing, which is where West Texas is priced, or to Houston, which is where our new oil benchmark, Houston crude oil, which is basically a waterborne price of oil, is being priced. Likewise, if you're in Eagle Ford, you may have to pay $9 to $15 to send it by rail or truck. By contrast, if you're in Midland, the brown area, in the Permian Basin, you can send it for $2 to the pipeline to Houston. Currently, the pipeline has a capacity of 2 million barrels per day, but there are other pipelines coming online late this year that will boost that to 4 million barrels per day. But the point of all this, though, is that production in the Permian has been stable, largely because the amount of investment rebounded. And the reason why it rebounded is because it's easy to get oil out of the Permian to other places where it can be sent to other regions of the United States or the world. By contrast, investment collapsed in all of the other regions after prices dropped through about $70 per barrel. So the market's thinking could be, okay, if there's a huge disruption in the Middle East, that's terrible, but production can increase not just in the Permian, but in every other region of the United States. And that could send oil production soaring, and it could compensate for much of potential lost production in the Middle East. I'd also be remiss if I did not mention the explosion of shale gas in the United States, particularly in the Green region in Appalachia, in a sort of central eastern region of the United States. That has increased very dramatically. The United States is about to become a bigger and bigger exporter of natural gas. Natural gas traditionally has been a regional market with very different prices between Asia, Europe, and North America. We have a new benchmark coming online for liquefied natural gas, but the existing Henry Hub benchmark is becoming an increasingly important global benchmark. So this all brings us, we have strange events in the oil market, of course. We have equally strange developments in the equity market. I think are big consequences also to commodities and to fixed income. So this weird thing in the equity markets, you look at the S&P 500, they're in black. It's super optimistic. It's trading about 2% away from its all-time high. In sharp contrast to that, you have the fixed income market. Fixed income market is expecting the Fed to cut interest rates very dramatically. So Fed's already cut twice. Fixed income market thinks they're going to cut at least 2 more times, maybe 3 more times, or maybe even 4 more times over the next few years, because the fixed income market is very worried about economic growth. So there's really only one way this turns out happily. The equity market can only be at record highs, and the fixed income market can only expect Fed rate cuts if the Fed actually follows through with rate cuts. So the first 2 rate cuts, the Fed decided somewhat reluctantly, with 2 members voting against in July and in September. But the outlook for the October meeting is very cloudy. Our Fed funds future basically says that there's only a 40% chance that they cut. So what that means is if they don't cut at the end of October, we're going to have a lot of very disappointed equity investors. Also, notice in the equity market so far in 2019, began with a propulsive rally, a lot of momentum. Now it's completely losing momentum. Might be the equity market's about to have a really, really big correction as we go into the last few months of the year. If it does, that will push interest rate expectations downward even further, and people might even begin to expect that the Fed will return to close to 0 interest rates. The fact of the market correcting in this manner, of interest rate markets expecting a decline in Fed rates, has been hugely bullish for precious metals, especially for gold and for silver. Gold and silver both have a strong negative correlation with interest rate expectations in the United States. So if expectations move toward lower interest rates in the United States, gold and silver prices typically move higher. That's what happened over the summer. And of course, we saw a correction. The markets sort of revised their expectations for interest rate cuts downward a little bit. So gold and silver corrected a bit. But if the equity market corrects, the bond market will come to expect more rate cuts, and that could send gold and silver prices much, much higher. So we normally think of the equity market versus the dollar. We don't normally even think about it. It's just part of how we view the equity market. We normally think of the S&P 500 in index points, but essentially the S&P 500 is an exchange rate. It's an exchange rate between the shares of those companies and the US dollar. And so, just like shares that trade at Bursa Malaysia or an exchange in Kuala Lumpur are essentially an exchange rate versus the Malaysian ringgit. But one could always redenominate any stock market out of its traditional local currency like the dollar and redenominate it into gold. So if you look at the S&P versus gold ratio, you see incredibly violent movements. From 29 to 42, stocks fell 90% versus gold. Then from 42 to 1967, stocks rose about 2,000% versus gold. Then versus gold from the late 60s to 1980, stocks fell 95%. Then from 1980 to 2000, stocks rallied a modest 3,200%. Then from 2000 to 2011, stocks fell 90% in gold terms. But then since then, they've rallied back by about 320%. But they peaked out almost a year ago, in late September last year. And since then, they've fallen 24% versus gold. My concern here is that gold might be a huge outperformer versus equities. Could be the equity market maybe falls somewhat in dollar terms. It falls a huge amount when viewed in gold terms. What this reminds me of in some ways is the late 60s to 1980. If you look then, there was a huge drop that occurred from the end of the 60s to 1974. Then there was a counter-trend rally, a very strong rally in stocks in 75 and 76. Gold prices went the opposite way. Seemed like, oh, maybe equities are all fine, but then a second shoe dropped. So this time we had a first wave down from 2000 to 2011. We've been in what might be a counter-trend rally between 2011 and 2018, but it may now be that gold is getting the upper hand and will dramatically outperform equities. Another reason to think gold might do really well is the US dollar. The US dollar, which you see here in the Bloomberg Dollar Index, there in the light blue line, has been a strong currency since 2011. If you wonder why gold has been sinking, a lot of it has been because the dollar has been strengthening. The dollar typically strengthens when the budget deficits and trade deficits get smaller, and the dollar tends to weaken when the budget deficits and trade deficits get bigger. The bad news now for the dollar is budget and trade deficits are getting a lot bigger in the United States. And that could be really bad news for the dollar during the 2020s. But as you see here, the dollar has a really strong negative correlation to the price of gold. So if the dollar weakens, it's very likely that the price of gold will strengthen. So this is another reason to be maybe very optimistic about gold during the 2020s and not so optimistic maybe about US stocks. So gold and silver, of course, also have options on them, as do all of the other things that trade at CME Group. Their options have been spiking recently, but they remain at very, very low levels. Gold and silver options are still very, very cheap by historical standards. Likewise, corn options, extremely cheap by historical standards. Same thing for wheat options, incredibly cheap, almost never cheaper than they are today. Same thing with soybean options, for example. Soybean options also trading at historically very, very low levels. Same thing through with government bonds. Government bond options have spiked over the last few weeks, following in line with what's happened with gold. We've also seen equity index options also starting to rise off their lows, but remain at very, very low levels. Last thing I want to point out, there was a cycle between volatility and the easiness or tightness of US monetary policy. So typically if you have a flat yield curve, meaning you're at the bottom part of the chart, and you have high volatility, meaning you're over to the right, that cuts off credit to the economy. The economy goes into a recession. The central bank eases policy, that steepens the curve. Over time, a steeper curve will, of course, causes volatility to fall. Central bank then raises interest rates, which flattens the curve. And then you have a year like 1996, a year where markets are boring, they're not moving very much, but you have a flat yield curve. And that usually translates into an explosion of volatility. Same cycle repeated itself in the stock market in the next decade. Flat yield curve in 2000 and 2001, recession, Fed cuts rates. Over time, that reduces volatility. Then Federal Reserve says, okay, it's safe, we can raise interest rates. So they flatten out the yield curve, raise interest rates a bunch of times. Then you have a year like 2007, boring markets, not very much volatility, but then a huge explosion of volatility comes after that. Now we have come full circle once again. We have a very flat yield curve. Volatility is still low, but it is beginning to rise. This pattern is playing itself out in many, many different markets. Same cycle plays itself out in treasury options. Treasury options also now beginning to turn a corner to higher volatility, but volatility is still really cheap. Same thing in gold options, following the exact same cycle. Gold also turning the corner to higher volatility. Same thing in agricultural options like corn and wheat, also following the same pattern, starting to move to higher volatility. I think the Fed's rate tightening cycle is enormously consequential. It could result in a massive explosion of volatility. We're beginning to see wider credit spreads, very narrow equity market rally. It seems to me like we are heading towards some sort of major peak in the equity market. Maybe we'll have a correction in Q4. The Fed will cut interest rates very dramatically, and everything will go on and recover. But I think as we get into the later stages of this equity bull market, And I think we are in the late stages. It's going to become much more erratic. Equities may continue to go higher, but as they go higher, they will become more and more violent in their upward course, like they were at the end of the 1990s, and eventually will translate into a big bear market. When that bear market happens, the Fed will have to cut interest rates back towards zero, and that could potentially send the price of gold and silver very, very much higher. So that is it for the presentation. I would be thrilled now to take a look at any questions that you've asked during the last hour, and I will do my very best to respond to as many of those questions as I can in the remaining time, which is probably about 10 minutes or so.